Okay, good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, January 22nd. Michael Boutros here with you this morning, guys. Good morning, Iman. Hope all is well with you. Same to you, Iman. Robert, Jaya, Muhammad, Peter, Pete. Pooja's in the house today. We got Tom, Ziad, Kamal. Great to see you guys all in the room. So, start to a shortened holiday week. Obviously, markets in the U.S. were closed yesterday for Martin Luther King Day. I hope you guys enjoyed your day off for those of you who are off. But back into business. Look, there is a litany of headline event risk, okay? You're hearing it come from Brexit. You're hearing it come from the government shutdown. You're hearing it come from China's slowdown and concerns of what's going on there. I noted yesterday you did get the release of China GDP numbers. You saw headlines and markets run with the fact that you saw, you know, growth contract, but it is, or it was rather, more in line with expectations. So not that big of a miss. Certainly not what you want to see from one of the world's largest economies, but nonetheless, you're seeing that markets are kind of like on a shaky ground here to start off the session for the week. So today on the menu, we'll cover DXY, Euro, Aussie, Gold from last night's updates. We'll hit up dollar CAD, Thursday's update on Aussie Kiwi, Euro Kiwi, Sterling Kiwi, and then we'll hit Kiwi dollar, obviously. And then I do want to just talk about sterling prospects moving forward. The Brexit headlines are going to continue to circulate, guys. It's going to continue to be an ongoing theme for markets. So, watch price. Forget all the noise. There's so much noise right now, but we're just waiting for clarity in price. Now, as it pertains to the technicals, a lot of these trades are kind of stuck, right? Really sideways lateral movement, range-bound activity abides, but certainly all of these conditions give way to larger moves. So hopefully we'll get a kick as we get into the close of January trade, but there is a lot to cover. So let's jump right in. As always, guys, trade setups, questions you have, feel free to throw them out at any time period. DXY, here's where DXY was last week. This is back on the 15th. Here's the weekly chart. It's pretty clean as far as where we are on that front. Okay, we were looking for a necessary break below this 38.2 line of the pitchfork that we've been following. Support, break, acceleration was resistance here. Here's the rebound. Looking for support right there on a closed basis. It's exactly where we rebounded. Okay, it's exactly where we rebounded last week. So the possibility still for some more upside. This is from the weekly chart, right? 1,000 feet up. There is a possibility for a little bit more upside here, but again, even if we push higher into former channel support, as long as we fail ahead of the high week close, I still think you're good. I still think you're testing the underbelly of a larger resistance. Support, resistance, resistance, resistance. All that converges still right here. So look, base case scenario from my end, if we move higher from here, again, looking for failure ahead of 97.42, 97.87 would be the resumption trade. If we break this, there's really nothing to stop it from going right into 100. The uncovered close is 99.98. Slope resistance comes just ahead of that. So, this is a clear pivot in price, guys. And a breach above 97.87 pretty much draws the line for, a rally towards 100. Not my favorite scenario, but certainly we have to have an objective picture of where we are in price. Ty saying we held the MA. Absolutely, Ty. Another one. We actually technically closed below it here on this first week or the second week in January. So you can see that we actually did dip below it briefly on a closed basis. But nonetheless, further highlighting that region, right, Ty? Further fuel to the fire. I'm with you. So look, ideal scenario, this thing moves a little bit higher into the US Open here for the weekly session here, and then we start to fail towards that parallel. If we break through, I'm going to take a more neutral stance here, see how we react near 97.42. But that's sort of the base case scenario. Remember, the way that we got up into this resistance slope on building divergence with the trigger break, if this is legit, then the recoil here should find resistance ahead of that slope in momentum. The recoil in price should find resistance ahead of that slope in price. Reversal candle, says Ty. Which one? So this is considered a reversal candle, yes. After a 4-week decline, you had a reversal candle. It wasn't an outside weekly reversal, Ty, which is what we like to put a little bit more emphasis on those, like this one, right? Where the previous candle was covered both on the downside and the upside, we closed higher. That's a pretty conviction reversal candle. This one, not so much. Make sense? So that's where we are in the broader picture. Okay, could get a little bit more upside on the DXY if our interpretation is correct. If this breakdown is legit, we should be looking for exhaustion heading into that median line or heading into that slope line. Here's DXY on the daily chart. Another couple of concerning things to look at. You know, if we look at this objectively, basic trendline resistance off that high from December looks like we broke. 50% retracement, 96.37. Looks like we broke. But if this was going to be a break, we would want to see acceleration here, right? A break of downslope resistance, specifically confluence resistance, very decent pivot in price. I would have wanted to see this give way. Now, not only did it not give way, but we're on our third day where we pushed above and no real traction, right? The objective monthly opening range is still up here at 96 and 97. So just to put things in perspective, you know, I don't have a very strong opinion. I definitely don't want to be buying up here at the, you know, multi-day highs, but I don't want to be shorting it just yet either, because I could still see this thing hitting 96.69 before it turns over. Get a quick 618 tag, you know what I mean? Then pull back. I don't know. All I know is that a concrete break and close below 96 is really what set things off. You have the 100-day moving average. You have the monthly open just above 96.17. Then you have basic trendline resistance. And that would necessitate a break below all of them. So the thing that would put me back on track in DXY is if we get a material pushback below 96, I think that would bode well for resumption. Near term, you know, you're still risking that rally towards 96.70s, 96.69. Excuse me. Intraday looks like this. So there's the ascending channel formation that we were following from last week. No change to that. Okay, so here's that daily chart. Now we're tempting this break above 96.37. Here's the intraday, and this is the level that we popped right through, and we're straddling that right now. So what do you do in a scenario like this? Look, if we get below 96.20, in my humble opinion, for me that would be the go-ahead, right? To start to look to fade rallies. Specifically, it closed below the 100-day, moving average here. That would, you know, in my mind, mark resumption of the broader downtrend. Okay, so it's make or break here, do or die early in the week. You don't want to do anything from these levels. If we get a stretch higher, I'm looking for failure here. If we get a stretch lower, I'm looking for a break and a move below this to validate, again, that we're looking for resumption of the broader downtrend. Any questions on DXY? Now, the one caveat I want to throw out there, guys, is that we do have, you know, the government shutdown is really weighing on data, right? We're not going to get, or the U.S. data prints have been lacking. Obviously, the advanced goods trade balance and retail sales data due tomorrow. You know, that's delayed. Who knows if we'll get that information or not. With the government shutdown, you're not really getting the dissemination of all these reports that we typically get on a weekly basis. So, you know, from the event risk standpoint, it's hard to really call that. We have to see what happens with this government shutdown if and when we do get a resolution there. As far as DXY is concerned, again, ideal scenario, you get that stab towards 96.69, you look for failure there. If we get below 96, I think we're right back on track. Questions on DXY? It's number one. So a slight adjustment to this setup here, just basically looking with the new retracement with the new high that we registered. Okay, same slope. You're trading just above this region right now. It would get back below this is what would put us back on the bearish track. All right, back to last night's update. Let's hit the euro dollar real quick while we're at it. Here's euro. And certainly from the weekly standpoint, again, very similar to where we are in DXY. No surprise. Euro 113 is still the critical support barrier. We've been talking about it for months. I'm not going to bore you with the whole discussion again, but that's still the major key support. Okay, huge pivot in price, longer term moving averages, you name it, all stacked up right here at 113. Key resistance still 115.86 on the upside. That's the breakout that you need to validate, larger reversal in the euro. So to start off the year, this is essentially your world for euro 113, still key support. Daily chart looks like this. Okay, so we're now checking the 618 objective retracement of the advance off the November lows. That's 1350. Okay, we're sitting there right now, just lower. You have basic trendline support off the lows, pitchfork support, whatever you want to call it. It's just lower, right? And you're like 1330s, 1325. So you have this region right here where, ideal scenario, again, you look for some exhaustion on the downside move into this region early in the week if this is going to work, while keeping in mind a couple of things. The objective monthly opening range low, okay, comes in right here at 1303, excuse me. Stop traffic, that's the same level we're looking at on the weekly charts. Any way you slice it, 113 is big for euro. Okay, if we get down there. Now, intraday looks like this. Okay, haven't taken a long here yet. It's kind of the way I want to approach it is look for a spike. If we get below 1325, like I said, that starts to really, what's the word I want to say? That really starts to suggest a lot more risk at hand here, right? So the basic focus of the trade is if we get the drop earlier in the week, towards this 1320s area, 1330s, maybe even on a spike, I want to see exhaustion down there. I want to see price start to look for a stronger rebound. And again, for me, that entry somewhere in that region against this stop would be a really nice tight scalp, 20 pip stop or so. And that's against the January opening range lows that we made right into the open of the year, right? Another objective region. So if euro sinks and pushes sub 113, guys, that's the objective monthly opening range low. At that point, we have to be looking lower. But until that happens, I don't think it's there. I don't think it's there. Okay. Robert says Thursday ECB rate gonna be the acid test. We'll see how that materializes. Absolutely. We'll get, again, Thursday is going to be the ECB interest rate decision. No change to the interest rate is expected, obviously, but the commentary is going to be the whole 9 yards. Obviously, the ECB. I'm personally interested to see what impact, if any, they cite Brexit as having on the broader euro area, especially with the lack or the failure to come up with a material plan here for the UK. It's going to be interesting to see if those concerns start to weigh on central bank policy moving forward. But yes, Thursday, ECB. Hopefully we get some play there. Right, Robert? Hopefully we get some play there. Again, ideal scenario, euro takes a tank, really takes a dump, and then fails at the lows. But we'll have to see how we react around this 1320 area. Any questions on euro? So no change to any of the levels from last night. This is kind of a rework for the levels that we've been looking at. All of these slopes, guys, is very, very basic, but a lot of times these things can offer some great tell and price. There was no structure off the high that really gave this thing some flavor, but basic trendline support or slope support of that decline. A parallel off the high here looks for support, break, acceleration, resistance, converges on the weekly opening range high. That's 1391. Slope support converges on the former channel support or channel resistance, now support, also the broader uptrend right here at 1320, 1325. Questions on euro? All right, that's number 2. Just an added note. Sorry, guys. Test there. Just pause there. I was looking at the IG Trader Sentiment Index, and looks like um, there's actually a lot more traders stacking up on the long side right now. The ratio is 1.7 to 1. So for every one that is short, there's 1.7 traders long. Tends to give us a little bit more of a bearish near-term approach. So looking lower here into the open, see if we can't find that stretch near 1325. Okay, that is euro. Number 3, Aussie dollar. So Aussie looks interesting to me because if you guys remember on this one, we've been trying to short it a couple of times, or I did. I took a couple of shorts on this. One of them break even. One of them half took a stop on the rest. It's all about this big region at resistance, at confluence resistance for Aussie. Here's the weekly chart. It was 72.40 essentially. You look at a basic 764 retracement of the decline off the highs that you made back there in December. Not really so much a fib resistance, but just basic slope. This pitchfork off the highs from 2017. 2018 has caught the lows on the decline. And here's the upper parallel resistance and resistance. So it's been a tough trade. It hasn't been able to get much push to the downside. We finally turned lower, and the focus right now for Aussie looks like this. Here's Aussie on the daily chart, and here's what we looked like last night. So 71.45 was the level that we were looking for as support. If we break below that, by the way, that's the 618 of the broader decline from that December high. But if we break below that, there's two levels of interest. First of all is going to be this parallel right here. I think it's just around 70.86 or so, 70.90 is going to be this slope. We don't know if this slope has any merits yet. We haven't gotten inflection off the upper parallel or lower parallels. All we saw was a break in acceleration through the median line. That's it. So the focus right now is this pullback going to give us any type of play down here near 71? So Aussie, if you stayed in that short from last week, or if you're holding it, I think you're all right. The level for me that I was looking at last night was 71.33. I noted that as 2 equal legs down from the high, guys. So even if this was going to be more of just a corrective approach than a rip higher, 71.33 would have been the last level to look at. Well, here's the break, and here's the tested resistance right now as we speak. So the next level down is 71. Again, similar to Euro, guys. This is what I'm looking for. If Aussie slips lower into the open, I don't want to chase it with short exposure from here. Like I said, if you're holding shorts from last week, you're actually sitting pretty good. I'd have a stop against if you're conservative, you want to play it closer to the chest against the Asia high here, but basically, a stop against the weekly opening range high. Looking for a drop near 71. Okay, now 71 is that median line that we looked at in the daily chart. If you take the current slope consideration off of these highs, a parallel here caught the low. Looks like we're pivoting there as resistance, which is why I was looking at it last night. If you take that same slope to the swing low that we made back on January 19th, that converges on the median line. I didn't want to throw this into the report because I just wanted to keep the chart clean, but that's essentially where I got this level, both in time and price, right around the 71 handle. So now that we've slipped below 71.33, the correction, quote unquote, type of scenario holds less water, right? Holds less water here. So, it's either a correction and recovery back above 71.70. At that point, it starts to look for longs again, or if we get the drop into 71, look for exhaustion, look for divergence in price, look for something to prompt some sort of long entry off that region. If you're holding shorts, this is where you want to look to clean up the remainder of your trade. 71 is sort of the line in the sand. If you get below 71, you could see 70.40 in a hurry. Yearly open comes in at 70.42, a basic 38.2 of the advance off the monthly opening range low. Your January lows is only 70.48. So nice spot there if you do see the break below support at 71. But the focus right now is for a reaction down here. Now, as far as Australia event risk is concerned, you're pretty clean until later in the week. Wednesday, you do get, well, I say Wednesday here in New York. Thursday morning in Australia, you do get the employment figures, expecting to see an 18,000 print for the month of December. Not quite as high as the previous read we got, 37,000, but that was like a blowout read we got in November. So we'll see how the employment data looks for Australia Wednesday night here in New York, Thursday morning in Aussie. Any questions on Aussie? You know, I've been trying to look for some structure here all morning long, for some slopes, something to give me an idea, scenario of how I look to attack this. But it's interesting. If you take that same slope, you might be asking yourself, well, Mike, why the heck did you extend it from there? I didn't. I'm extending it from here. But what I want to see is, does the backwardation of that slope give us inflection as well? And it certainly does. Here was resistance. Here was the break, which fueled an accelerated advance. Support, support. Wait a minute. That same slope again converges down your 71. So again, ideal scenario, you see some sort of failure into this region. If we breach back above 71.45, would look good. It's the break above the opening range high for the weeks that would suggest, okay, look for resumption. Any questions here on Aussie? Going once, going twice. Okay, we'll take a quick segue into gold before we jump into the rest of the dollar crosses, just because I think you're at a big inflection point for gold. It's going to be a pretty big week. Here's what gold looks like on the weekly charts, and here's what gold looked like. For us over the last couple of weeks. I'll give you a reflection back to the 17th when we put all the charts together. Here was the weekly level. We're broadly bullish gold, guys. No one's saying anything to dispute that. But near term, last week we talked about it. The week before that, we talked about it. And the week before that, we talked about it. Since the start of the year, we've been talking about this slope resistance, basic slope, offering sort of a cap to the advance that we've seen in gold prices off the lows from August of last year. Basic pitchfork resistance, you got the yearly open from last year at 1302. That's the level we need to best to validate a breakout, a larger, longer term, multi-year breakout in gold. As long as we stay below 1302, the risk is there. Here's the daily chart. Now, last week, obviously, we had that consolidation region. We talked about it for days. I really wanted to see how that was going to give out. Not only do you have this consolidation region, wedge, triangle formation, symmetrical, whatever you want to call it, you basically had price consolidating below slope resistance with a clean monthly opening range. Now, what is making me super interested in gold right here is this. The triangle break did materialize last week, but that decline is now testing the objective monthly opening range. So if this holds, let me take a step back. We can't just assume looking lower because it's a triangle break until this breaks. So it's really, for me, 1276. Robert says, Mike, would selling out of that 15-minute or hourly contraction range in the triangle have been a valid play, a break of the triangle, or that type of entry high risk? You talking about this right here, Rob, in gold? So I'm going to touch on this I'm going to tiptoe around it because, Robert, I don't want to encourage risky behavior when you're trading. So the trade here would have been, let me take a step back. If you're talking about this break here, no. If you weren't pre-positioned ahead of this break, Rob, I would have been hard-pressed to take anything. Okay, the trade here would have been selling rallies against the range highs, because every time when price, let me take a step back. Let me put this as simple as possible. Rob, when price is in consolidation, the easiest trade is to trade within against the range highs. So every time a new high is made, if I take a short here, it's against this high. If I take a short here, it's against this high. If I take a short here, it's against the previous high, right? Because it's in consolidation. So if the consolidation holds, you should see a lower high made. Same way on the way up. I'll be more than happy to play alongside within the consolidation because I don't know what direction it's going to break. But every consolidation you take, or every long you take, should be against the previous lows. Once you make a new low, that long you take should be against the previous lows. That long you take should be against the previous lows, and so forth. So if you're pre-positioned into the apex, when a break like this happened, you're just looking to shave off. There's no new entries here, okay? Now, Rob, if you're a really quick trader and if you're trading on the trade desk or you're sitting on a trade desk all day long or you're watching the charts, yeah, a short after that break, if you're nimble enough, sure, you might get away with it, right? But, that kind of trading behavior, Robert, it's going to sting you in the long run more so than it will hurt, more so than it will help. Let's just say that. Risk tolerance needs to be paramount, guys. Even if you have 80% conviction in your heart, oh, this is going to move down. I see the break. Direction is just 50% of the game. There needs to be a trade setup, okay, which means a dictated, well-defined stop that makes sense with what your risk parameters are. So, Robert, that's the only thing I'll say, man, is that, if you're nimble enough, that's fine. But, it's that discipline that makes a successful trader from a non-successful trader, or, a noob trader from someone who's been doing it a while. It's just that simple discipline. Whereas even when you recognize direction, even when you recognize price, even when you recognize what the market's doing is what is in line with your expectations, unless there's a disciplined stop set up, we're just chasing. Make sense? Robert says, got it. Okay, cool. Good question. Good question, Robert. Hope that helps, sir. So for Aussie, or for gold rather, if this is what I wanted to say last night is, if this breakout is legit, right? Here's the triangle breakout we were looking for. This is the first level of support that we should be looking for. Slope. Again, the monthly opening range lows comes in just above that now. And that's a break that would be objective, aside from Mike Boutros or Jamie Setley or anyone, that would be an objective break of the monthly opening range low and would fundamentally shift the technical picture lower. In such a scenario, you're looking for a drop into a basic 38 to the 236 of the advance, and that's 1265. But right now, to start the week, essentially the focus is on, if this holds, then you're still maintaining the January opening range. Resistance up here. Again, once we take topside break 1302, where we missed back here, that's still the major key resistance range for gold. Not a damn thing has changed. This is still huge resistance. So look, it's either another stab at the lows here, failure, and a move higher to break the upside. If it rallies and fails here against these highs, then you're looking for the downside break and you look to assume a break towards 1265. But this is sort of a nice spot. If gold is going to rebound, this is the spot. Okay. Now, one other thing, I didn't want to clutter up the chart, guys, just for reference. If we do break a measured move of the triangle break would actually give you a target down at 1254. 100% extension. So if we take just a measured move, the triangle breakout, that would be the risk to the downside if this gives out. First target would be 1265, but right now the primary focus for me is this right here. Make sense? Questions on Aussie? And the risk is there, guys. Remember where we're coming from on the broader charts. Weekly opening range is set. We're testing the weekly opening range low. There's slope there. There's former channel resistance there. Should be support. And on the broader scheme of things, looking at the weekly gold chart, we're coming off of slope resistance. Period. End of conversation. So even a drop near 1265, which is what I put as bullish invalidation. Why 1265? Well, it's a basic 236, but it's also the 52-week moving average. And if we break below that, I think that would signify that a more significant high is in place. Near term, you're just playing a pullback off of resistance. Whoops. So, no change to any of those levels from last night. We're basically looking to see if we can get a reaction play here above 1275, 1276. Questions, comments, concerns on gold prices? Okay, circle back to some of the updates that we had from last week. Dollar CAD number 5. What to do with dollar CAD? So I've made a slight adjustment to this slope, but it's still basically the same setup, guys. It hasn't been too exciting. Here's dollar CAD. Made a slight adjustment. Remember, the focus has been for a larger rebound in the trade before getting resumption. Ultimately, we're looking for this rally to give us better entries for short exposure. Levels of interest, 2 of them, 33.70 and 34.23 into 34.35. We talked about both those regions for a while. So I wouldn't worry about that 200% extension. It's a measured move of the advance, but the 38.2 comes in right here at 33.65. Here's 2 equal legs off the low, 33.40, and basic slope, support, take a parallel. It all converges basically in this region. So it's a messy setup at this point, in my opinion. If you're holding longs, I would begin to shave some off here. 33.65 is where I take a little bit more, if not all, the position off. Again, I'm thinking that this thing kind of gets some sort of blow off here near term towards the highs before giving us a little bit more of a turn back lower. Retail on this one has been almost neutral. So they're not net long or net short. They're basically sitting, more neutral tone, which just suggests that vulnerable for some sort of turn in price as well. So initial focus is on an approach here to 33.65, 33.40 is what we're trading above. I want to see something happen here. In dollar CAD. Dollar CAD in the weekly, by the way, just to give you a quick reminder. Right? Huge reversal to start off the year. Huge reversal off of major multi-year slope resistance as well as Fibonacci resistance. 618 retracement of the entire decline from 2015, I guess it'd be 2016, open highs. So big region. That's the turn. We even broke near-term upslope support from last year's low, or I guess last year's October low. So the recovery, sure, it could still have some upside, even all the way up until the 34.35 level, that's 2017 open, would still be a test of former support as resistance before we move off. Ultimately, though, looking for a deeper cut lower in dollar CAD. Questions, comments on Loonie? All right, let's jump into the Kiwi crosses. I don't know what got into me last week, but all of the Kiwi crosses looked super interesting to me. So let's start off with Kiwi dollar, and then we'll circle back to some of these Kiwi crosses. So, excuse me. Here's what Kiwi dollar looked like back on the 16th. We're looking at some clean parallels. It looked like it was testing parallel support. Long story short, if we broke below this region here at 67.48, it would keep the short bias in play, targeting 67.17, 67.07. Okay, it was a decent pivot in price. Near-term resistance, 68.25. Bearish inval was 68.50. So we got the downside break of that formation. Okay, here's the upslope. There was the break, tested it as resistance. Here's 67.17 last night. Here's 67.07. Perfect tag. Now on this last dip, you're seeing divergence in price. No, I'll take that back. Was it an hourly chart I was looking at? Okay, well, it's not strong divergence, but nonetheless, there's the vulnerability. And 67.48 is the near-term resistance level I would need to see give out to get this thing back on the constructive side. For me, this is also the monthly open. This is why I wanted to highlight. The monthly open actually comes in at 67.05. Okay, that pivot in price comes in at 67.07. Here's the drop right into it. So think you can get some upside here in Kiwi dollar, but ultimately it would need to be a larger break above the weekly open 67.50. That would put you back on constructive footing. But I do think you get a little bit of a recoil here or a rebound. Keep in mind, guys, this thing has seen 1, 2, 3, 4, 5, 6. It'd be the 7th consecutive down day. Today would be the 7th. Last time you saw that was back here. You saw a 1-day recovery before resumption. Back here. That was actually a 7-day decline. So that would match today's decline if we do get another low today. And that ended up being a multi-month low. What about previous to that? Here's another 6-day decline. That was a low. Okay. It's pretty base. It's 3 out of 5 of the last ones saw turns in price. Again, not suggestive, not technically significant, so we can't use that as some of any justification. But seeing as how we're coming into the monthly open, basic pivot in price with the highs we made September of last year, 100-day moving average just lower, essentially looking to 67 for support on Kiwi early in the week. Yeah, bearish excuse me, bearish invalidation would have to be that 200-day moving average right there, because that would necessitate a break back above former slope support, now resistance, and the moving average. It would also clear last Friday's high. Not bad. So that's Kiwi. I'm not really involved in it, like sort of as we speak, but certainly something we'll be tracking this week. So with Kiwi there, here are the Kiwi crosses that we covered on Thursday. I'll start off with Aussie Kiwi. We've been following this one pretty closely. The advance, continues to lose steam over and over again. Every time this thing starts to pick up some steam on the upside, it starts to fizzle out again. But 106.83 is a big level. It's not just a 50% retracement, a decline off the highs that we made of last year's August rally, but essentially is also basic slope resistance. I'll bring you back to the daily chart, which really shows basic channel off the highs. One touch, only two touch, so not a major resistance level. But in and of that self, that 106.61, 106.84 level is a huge pivot in price. Don't take my word for it. Here's price action. Support, support, whatever you want to call that. Break, acceleration, resistance, 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 break, acceleration, support, support, break below, resistance, resistance, converges on basic slope resistance off the highs. So 106.62 into 106.84, big resistance for Aussie Kiwi. Does it get through there? I don't know. Couple things I am looking at though. You're seeing divergence in momentum. Price action making a higher high on a closed basis. The oscillator making a equal or lower high. Notice both reference points at or below 60. Price testing resistance. Now that's not to say this is necessarily going to hold, but it is to say that if it does break, boy, we should see some sort of inflection. Okay, so it's either a drive higher through 108, 106.80 to the for the rally, or a failure here, and then you get the resumption back towards the lows. So that's the weekly or the daily chart and the bigger picture for Aussie Kiwi. Here's the scalp that we've been following on the intraday charts. So last week, if you guys remember, to the start of the week, we were bullish above 105.40. Again, the week, last week, after we made that rally and we failed, we started the week saying the same thing. Here it is again. Here it is again. That held a support at 105.40, topside breach. You saw 106.38 get taken out. 106.83 did not. We turned just ahead of it yesterday before pulling back. So the levels are still pretty good. We went for a rally here. We missed just ahead of that. We pulled back. You want to stay constructive near term while above 105.87. Again, that's the basic 618 of the advance from last week's low. That's also slope at this point. Topside levels unchanged. You really need to see that 106.83 level to give out. Again, on the daily chart, that's going to converge on that topside slope. This is not represented on the intraday chart, just for the sake of clarity. But if we add it, it comes up right here. Right? So that's the break that you need to validate. Major reversal type of play in Aussie Kiwi. Near term, support at 105.87. Questions on Aussie Ki? Okay, number 8, Euro Ki. Here's Euro, New Zealand dollar. Aha. So, another one we've been following very closely. If you guys recall on this one, the downside break below 107.45 was huge for us. It was, 167.45, 167.65. Big area, huge pivot, nice confluence region, 50 off the low, 100 off the high. The weekly opening range low was there. So once we saw that break, remember, I thought we were looking lower. 106.62 was the first target. It's a basic 618 and slope support. You got the break. You got the spike into slope, but you never saw 106.62 before this thing completely reversed and ripped higher, which is now testing our bearish invalidation at 169. Here's price. We even probed through that. 169.30 is an overnight trade. So where are we with Euro Ki? Bottom line, look, at the end of the day, basic. I try to play this as basic as possible. A couple things I'm looking at. A, we broke slope. That slope has been support ever since the breach. Support, support, support. So right off the bat, we need to break below 68.50 just to get me, okay, fine. Maybe this was just a false breakout type of play. Also, I'm looking at the fact that momentum is able to make above 60, but every pullback, essentially 50s holding is what we're testing or straddling at the momentum signature. So there's no momentum tell there either. Basics. And if you do that, look where everything lines up. Okay, 38.2 lines up with basic slope support off the monthly lows. Lines up with former slope resistance, channel resistance off of the monthly highs. And that continues to highlight 68.46, 68.50s is a big area of near-term support. So bottom line, look for a reaction there. If this is going to hold for Euro Ki, that's what needs to hold support near term. Okay. If we break that, guess what? You have a nice confluence region here. 67.80, 67.87. Pretty awesome pivot in price. Former swing highs, former swing lows, 618. Converge right there. All right. So if this breakout is legit in Euro Key, we need to see price stability today above 68.46. Topside breach, you're looking for 170, very simple target. If we slip below 68.46 today, I'd be looking for a larger dump before this thing resumes higher, and that would essentially be looking for 67.87 on initial approach. Any questions on Euro Key? Okay, last but not least, number 9. Oh, and then 10 we'll hit key sterling as well. Sterling Key and Euro Key. All right, and sterling Key and sterling dollar. Which one do you want to hit first? Here's sterling dollar. Well, let's say it's sterling Key first. Here's sterling Key. I just want to highlight that major resistance level that we were talking about. For me, that's the only thing I'm focused on here. Where's sterling Kiwi? Aha. Okay. So just want to show you this. This is such a massively critical level, guys, on so many different standpoints. Here's the weekly chart. You know, it's not very it's not very common for me to get excited about a sterling Kiwi cross, but this thing is so technically clear in my opinion. We'd be foolish not to look at it. First couple things. Weekly chart, objective stuff, right? No opinion here. It's the 50% retracement of the decline off the highs that you made last year in October. So the entire 2018 trading range is represented or covered in this one retracement. Something I look at. Okay, something I look at. B, you got the 52-week moving average, your yearly moving average converging. Stop traffic right there as well. C, you got basic slope support, former channel support, break, acceleration, maybe resistance, just higher, 93 and change, 93.70s. Long story short, big area on the weekly chart, right? Now let's jump into the daily. Well, a 618 extension from the advance off the low comes in at 92.14. There's that 50%, again, 92.97. Stop traffic. What else is there? The 100 and 200-day moving averages. So you got the 52-week moving average, you got the 100-day moving average, you got the 200-day moving average, and the 50% retracement of last year's range right here, all just below 193. In case that wasn't enough, sprinkle some slope on top. Basic slope resistance, this is a parallel of this slope support, 1 touch, 2 touch, 3 touch. Parallel extended off the high from December, right there. Any way you slice it, huge resistance. 92.17, 92.97, both areas of interest. I know it's a big range, but we talked about this last week. For the 92.17 618 extension barrier, you also have former slope resistance, but a very decent pivot in price. Resistance, breach, support, break, acceleration. That same blue line converges right there today. Okay, so essentially the focus right now for sterling Key is, well, we should be looking for some exhaustion basically into 93 or ahead of 93. So it might be a decent pullback play. Here's the intraday chart. You know, no change to any of these levels from last week. The only thing we do need to adjust is just a slight adjustment to the retracement to, you know, respect the new high that was made. But levels are pretty much unchanged. Okay, here's the daily chart, again, highlighting both of these key areas of resistance. Here's the intraday. There's the first test. You pull back. Here's the second test. Again, we're looking for exhaustion, basically ahead of 93. Any question on sterling Kiwi? I know it's an interesting pair. A little bit more expensive to trade, obviously, on the spread. And It's a sterling cross, so the holding costs are more. But obviously, wherever price action gives us clear setups, we're going to continue to track them. Now, with that in mind, a quick look at sterling dollar to wrap things up. Look, the Brexit talks are going to continue to swirl. The headlines are just wicked. This thing just takes nasty cues off of everything that's going on. But for me, the focus has been pretty clear as long as the longer term picture is concerned. I know you guys have been following this with me. We've been talking about it. Man, 29.72 is absolutely critical, and that is the breakout zone. In my mind, if we're able to top that, I would love to breach, or I would love to be long here. I'm long sterling key. Would you be holding or getting out, Jeff? It depends where you're long from, man. If you're holding a long position, the ideal scenario. Let me get that chart back. The ideal scenario would be to shave off a little bit in 92.17, basically where we are right here. I'm not sure where you're long from, but from this standpoint, on this type of stretch into resistance, I'd have a break-even stop or better. The rest of it, I take off at 93 or 92, 97 into 93, this region. You know what I mean? That's the big level for me. So Jeff, you're long from 93? Wait, Jeff, can you retype that? 119? Is that a? I'm guessing that's a long. That's a typo there. Yeah. So let me know what level, Jeff. But long story short, if you're long from anything, I would say below the weekly open, this is your first target. This is your second target. Stops at break even. If you're long from something above 91.37, okay, that makes more sense. 91.37. So again, 92.17 was a target for mine. So I'd have something off there. Break even stop or better. Last limit at 92.97, 93 is where I would have it. But from your entry, 91.37, it's a great entry. And it's below the Asia low. So a break even stop for you on a trade like that, Jeff, would essentially just mean that you're playing with the house's money. And if it breaks the Asia low, inherently that's a bearish type of development. So that would put you out of the trade at break even. So I think break even on that one would probably be the way I would play it personally, Jeff. Watch for 93. Maybe if it hits 93, take the majority off and leave a little smidgen on. Because if you do see 93 give out, there should be serious acceleration. But Jeff, just recognize that you're trading sterling, man. There's so much event risk, man. The headline event risk is just paramount here. Theresa May could sneeze tomorrow, and all of a sudden, the Brexiteers will go nuts. So we'll see how this pans out, but just my humble opinion. Hope that helps, Jeff. Robert liked that comment, huh? Yeah, it's frustrating because we've been talking about the sterling long position. It's just that the whipsaw declines. Every time it drops, it stays there for just seconds before it rips higher. It doesn't even give people an opportunity to get in. So while we've been favoring, a broader advance here in sterling, this is sort of the biggest, the first area of major resistance on sterling key, and the same for a sterling dollar for that matter, right? Checking upslope resistance and downslope resistance, right? Huge level. Sterling, by the way, on the weekly chart, just to give you the consideration of where we are, massively important region. I really couldn't stress this enough. And this is why when you look for trade setups, guys, throughout the week, you look for those opportunities where they're overlapping, where sterling kiwi's trading at resistance, same time sterling dollar is trading at resistance. So the tell here is on the inflection or rejection of these key resistance ranges in the sterling. Again, ultimately, I do favor the long side. Near term, the immediate risk, yeah, the advance is vulnerable below 129.70 here in sterling dollar, below 93 in sterling kiwi, right? Anything sterling CAD? Sterling CAD, right? Testing nice resistance as well. It's a 52-week moving average there. Just all the sterling crosses are knocking on the door. Your sterling Oz, I still got a little bit long ways to go there. But I think should be telling week for sterling. Okay, and that's everything I have on my list, guys. Let me know if you have any other questions or trade setups you want to review. If not, we'll go ahead and wrap things up here. And we will pick things back up on Thursday. Remember, Jamie's on tap tomorrow with the midweek strategy webinar. This Friday on Daily Effects, I'll be having the Foundations of Technical Analysis webinar, guys. So encourage you to meet me there. If you have any other questions, can we do Euro Yen Thursday? Oh, I didn't see that question, Ty. Euro Yen lately, I haven't, but I'll definitely take a look for you. Hold on one sec. Euro Yen, huh? Hmm. Let's see Euro Yen on the intraday. Ha ha ha. All right. Yeah. So this is what I'll say to you. Do you remember, Ty? Do you remember we were talking about this last week? And hold on. Oops. Sorry about that, guys. Here we go. On the 9th, Ty. Remember this chart? So I said, look, this thing made all the N crosses and the Aussie crosses, for that matter, have just been sort of like whipsawed, right? Because of that major flash clash I saw. So the focus that I highlighted back here on the 9th was two levels of interest for major resistance. Right here, 124.94, 124.92, basically just below the 125 handle. And then just higher, you have 125.50, 125.58. That's the May low day close and the 2019 open and slope right here. So on this recovery, we're basically looking for resistance at one of these two levels to kick lower. Ideally, Ty, it held right where we wanted. Why? Because we had the lower median line parallel offering resistance there as well. So if this break of downslope support is legit, well, then that support line should offer resistance, Okay. Now I say that with a caveat because near term, it does look like we are in some sort of consolidation range. Okay, so here's the intraday chart. It ain't pretty, but this is sort of the consolidation range I'd be looking at, right? And look for a break of that to give you a tell. Key support near term still 123.17, 123.50. Key resistance, I'd still be looking for 125 as resistance or ahead of, right? But even if that gives out, Ty, don't forget the level that we just cited longer term at that 25.50 level, the low day close, yearly open, former slope support, break acceleration, that's resistance. All right, Ty, does that help? Take a picture of this chart for your reference. Nothing's changed from the chart that's on that report, but I mean these are huge levels. This is your bearish inval, in my humble opinion. That's the only thing that would put me constructive, straight up bullish euro yen would be, an assault on 125.50 and a daily close above at that. At that point, you'd have to be looking resumption. If this consolidation breaks lower, the low day close comes in at 122.66. That's sort of the first level I'd be looking for as support. Make sense? And one other thing I'll do just for giggles here. I hate using these retracements of the spike low, but just to keep things on an objective approach. Downside targets in the event of a break. I really don't know how this is going to play out, Ty. This is one of those ones I've been tracking for the last week and a half, but I haven't taken actually trade on it. So let's see. Let's look for a consolidation break here. He says looks pretty. I have it. Keep an eye on it, please. Too late to trade big stops, right? Yeah, you'd have to get into a big stop type of trade. I mean, yeah, there's nothing in this one, Ty, until you get the consolidation break. All right. Okay, we'll wrap it up there. Guys, thanks again. Best of luck trading this week, and I will see you all on Thursday. Cheers.